Here are the key changes from a financial planning strategy perspective from last night's budget. You can go back and look at the 2 previous videos that I've done which explain what the actual changes are. Quick disclaimer, firstly, these laws need to pass Parliament, and secondly, this is general advice. To get personal advice where your situation is taken into account, please seek the advice of a financial planner who can review your situation and the available strategies. The first important strategy consideration is that debt recycling may become more attractive. Debt recycling is where you take out a loan against your primary residence and use those funds to purchase shares, managed funds or ETFs rather than an investment property. Now, you won't be able to take a cash out of as much for these type of investments as you typically were able to for investment properties. However, the benefit is that you can still continue to negative gear through these structures, whereas under the new rules, it's only for new builds, and you may not want to purchase a new build property. The structure here is super important because you need primary residence interest rates. Anytime a bank tries to convert it to a margin loan, the interest rates just become way too high to justify it as a viable strategy. For retirees who are planning on selling a property at some point, the timing becomes super intriguing now. Because if they sell the property before 1 July 2027, they still get the 50% discount on CGT. And also, if that gain becomes below their tax-free threshold, then they may pay no tax at all. Whereas under the new rules, there's that minimum 30% tax post 1 July 2027. However, there appears to be one exemption here. If they are on a means-tested payment, such as age pension, then it reverts back to the old rules where you can get a 50% discount and have the tax-free threshold. So the timing here is super important, and it's really a tailored recommendation to each individual's situation. When we have these potentially detrimental changes to negative gearing and capital gains tax, it only strengthens the benefits of superannuation, investment bonds, and also using your primary residence in a number of ways. So for instance, paying down primary residence debt can be highly effective, but also potentially putting more money into the property if it's going to grow the asset value, because remember, we still always get the primary residence exemption for capital gains tax in the future. We know that they're looking to impose a 30% minimum tax on trust distributions, but it's good to see that they have carved out special types of trusts from this. So special disability trusts appear to be exempt, but also fixed testamentary trusts. And why they appear to be given this carve out is under both situations, the person or family has gone through either a death or a significant disability, and therefore they're giving that concession to people where they can still operate under the old rules where income can be distributed to that beneficiary and be treated under their potential tax-free threshold rather than having to pay the mandatory 30% tax rate. So given that they've made these changes to trusts, I think there was a real missed opportunity here to change the tax rules and allow couples to do their tax returns jointly or file jointly, which is commonplace in many countries, particularly the United States. And why it's beneficial is that it means that you can combine your income and then be taxed on that as a household. With Australia's system, where you're taxed individually, it penalises couples where perhaps one person is working and the other may be the homemaker or looking after children, because the person who's working gets taxed according to the marginal tax rates, whereas the person who's not working gets no tax relief. So if they were going to bring in this trust change, they should have at least allowed people to file jointly for tax purposes. Because as an example, I've got clients where they have a trust and they distribute income to the non-working spouse who's looking after kids, and they're going to be, quite negatively affected. The government does continue to make the rules more and more complex. Of course, I'm biased. I think everyone should see a financial planner, particularly if their situation is getting more complex. They have potentially high capital gains tax, they may have trusts, all those sorts of situations where tailored advice recommendations could be really advantageous.